Hello again, thanks for joining me. This week we're going to have a look at breakout above accumulation. This is a stock chart I've used a number of times recently. It's a stock I'm following quite closely. It's WHC on the Australian Stock Exchange. It's an energy stock and it's been in an uptrend for quite some time. If you look back, this was the most recent accumulation in here. Price then started to push out. I think this was actually a bit early, and if you look at it through my eyes, this was an extension of this accumulation and really formed bullish absorption of some sort. There was an attempt to bring the market back a little bit, but then the bullish absorption continued on, which is a form of accumulation in itself. Price has been uptrending for quite some time. Now you can see in the background there's been a couple of shakeouts more recently. Here was one here. This is the volume down here. This volume here and this volume here both included off-market transfers, and their volumes would have been much reduced if they weren't included. When we do this type of analysis, we're really looking at on-market buying. What has price done on the amount of volume actually traded on market? If I remember rightly, this bar here, which is this volume, would have only traded right down around these levels. If you didn't include the off-market transfer, it would have been low volume. Just zoom in a little bit. Now, we had end of financial year recently, and you'll often see markets come back around that time of year, either for tax loss selling or to use that period of time as an advantage. Either way, this market started to roll over in early June. Now, the first thing to notice is the shape that we've got in front of us. I won't say anything too quickly. If we roughly look at this shape, if people have been watching my videos, they may know what it represents. It's a W shape. Hopefully you understand that, and that's often a sign of accumulation. A W shape forms some sort of sign of accumulation. It's a bit like a double bottom in a way. And the inverse of that, an M shape, is often representing some sort of supply or distribution. So you've got your W shape as an accumulation and an M shape as a distribution. It's only rough, but it's a good guide. Now, this would represent the highs of the previous range. You can see volume came in on this bar, and remember this bar here actually continues up to the previous close, sort of like that. So this is a level to watch as well. Now this bar here had even higher volume, so this is another level that we should keep an eye on. Now, what's actually happened? Prices come down, whether deliberately or through natural causes, and you can see that there was quite a bit of buying on this bar. Volume increased considerably. Spread wasn't particularly wide, so there was likely some buying came in on this bar here. But the next day, price sliced lower on an increase in volume. This to me was more like a shakeout. At the time it would have been very threatening. The next bar reversed and pushed higher, but it only closed mid-bar. So if you were looking for a proper reversal and an acceleration higher, price would have need to close above the initial down bar's high, which is here. So that's what I've got this level here marked for. And it didn't really. Price came back a second time. So if we call this, let's tidy it up. If we call this a 2-bar shakeout or an attempt to shake out. This is like a test of the lows of the shakeout. So you've had a shakeout, a test of the shakeout, a response higher, and then a secondary test through here at the same level, and then prices accelerated away. Now, let's look at that a little bit more closely. Prices come back, it's reversed, but price hasn't completed the reversal. If price closed back above this level, you'd expect it to go higher. Prices come back, it's tested again. You can see that reasonable supply was drawn out again here. Whether that was because price traded below the lows of the initial shakeout, 2-bar reversal, because volumes were lower here on these 2 bars, but there was definitely supply drawn out here. But in response, price moves higher, back up to this level I keep marking. Price comes back, and then comes back further, and this time you can see that volume is much lower than this, much lower than this, and these were the down bars in response. There's very little supply in the market now. It was below the average line, and there's much less supply in the market. Price reversed here, but it didn't really accelerate higher, and then price gaps up. It gaps up and over this level that I've been marking. This was a bullish bar. Now, remember that this bar goes back to the previous lows like this. So this bar has stood up tall. Volume is only modest here. So there was no supply left in this range through here, and because of that, only a small amount of buying has allowed price to jump up and out of this accumulation zone. You would normally call this zone a re-accumulation, but there doesn't appear to be any great amount of selling over here, so perhaps it's best termed as a further accumulation zone. Whatever, there was buying in here. It shows a W shape. There was likely buying for sure, and whether it's accumulation, re-accumulation, or I'll call it further accumulation, there was buying in there. Prices jumped out. Now let's tidy it up. Here's the important level. Prices jumped out. Next bar has gone up slightly on an increase in volume, but it's closed really poorly, and that might worry some people thinking price is going to come back down, and at the time you may have thought that. So you would have had to keep that in mind and just see what happened the next day. But remember that there was an increase in volume, price has gone higher and then settled back lower, and you'll see this quite a lot in the market. I call it buy the offer, or that shape anyway. The fact that price has only closed higher on an increase in volume, if there was lots of supply in there, you would have seen the market at least close below the close of the previous bar, or even below its low, but it hasn't. It's closed as an up bar. And you'll see again on the next bar, volume increased again, price has gapped up from the previous close, it's pushed higher, and then it's drifted lower. The market does this on purpose, perhaps to flip out some of the day traders and make it more difficult for them. I call it buy the offer. But price closes poorly and threatens that it's going to move lower, but there's no downside follow through in response. It's an absorption bar. Price moves up, buys the offer, and then drifts lower into the close. But the fact that there's an increase in volume and price closes higher suggests there's not much supply in there at all. It just looks weak because it has a poor close. And you can see it again in response. Price accelerates higher, closes high on an increase in volume to confirm that there's no real serious issue going on with those bars that closed poorly. Price gaps up again the next day, and accelerates higher on slightly reduced volume, and then attempts to test for supply. Now, it's not a really great test, but the main significance of this bar is spread has reduced considerably as price comes back. So buyers have come in to support the stock as it's fallen back, and there's been sufficient buying to keep the spread narrow. Volume is still fairly high. It was reduced, but still fairly high, but the spread is half of the previous spread. So there's lots of buyers in the market, you can see that, and price gaps up in response the next day. That bar looks more like this. You can see the shape of the bar when you put in the gap as well. Price accelerates higher on reasonable volume, and then once again price gaps up the next morning and pushes above the previous bar's high. Now, you should always remember that when you look at a bar itself, let's look at this bar. Effectively, the high of the bar is where resistance has come in, and the low of the bar is where support has come in. So you've got support at the bottom and resistance at the top, and that's why when you get an inside bar, a bar that trades in here, there's often reduced volume because price is traded through there. It hasn't threatened resistance, it hasn't had support necessarily come in, so you get lower volume on an inside bar like that. And it's always a minor positive when the market pushes above a previous bar's high. So let's just tidy this up. Let's look at putting that important line there. Let's look at these two bars here where they closed poorly, and you would have had some consideration at the time as whether they were going to be like an upthrust and close back lower. But remember, this bar has pushed above the previous bar's high and closed as an up bar on an increase in volume. So it's threatened the resistance above this bar's high, but it's just settled down in the afternoon to close back down near its lows. Then once again, the next bar has pushed above the previous bar's high, threatened the resistance, perhaps absorbed some of the supply above it, but then it's just drifted lower into the close. Each time these bars are going above the previous bar's high. It's a good sign, and it's a positive sign. It doesn't necessarily mean the whole market is bullish, but the relationship between each bar to the previous bar is positive when the market has pushed above the previous bar's high. And same when price is moving lower. If you look at this bar here, and price has pushed below the previous bar's low, it's broken through the support that was in the lows of this bar. And then the next bar has broken through the support in the lows of this bar. It's a minor negative. It's not bearish, but it's a minor negative in the relationship between the two bars to each other. Here's the lows, this bar's broken below it. Now you've got an inside bar. This bar here has pushed above the previous bar's high, so that was a positive at the time, but then the next bar has pushed back below it again. There's a bit of weakness come in, and traders in particular, short-term traders, decided that was a time to get out and take some profits. Now, more recently, after the breakout, you had price accelerate higher here with a very small pullback, just one bar was here. Then price accelerated higher again, and price has pulled back a second time. You'll see that there was 3 up days here and 3 down days here, but look at how much more ground the up days made compared to the down days. It's the same number of days, 3 up days, 3 down days. And here they are here, 3 relatively high volume, all above average, and 3 down days. Reducing volumes, the second 2 below average, that's these 2, where spreads narrowed, price didn't really go much lower. Look at the closes, they're all level with each other. This bar did break below the previous bar's low, but closed back above it again, and this bar traded as an inside bar on very low volume. The next day, which was yesterday, price gapped up and accelerated higher on an increase in volume, which is quite a positive result. And it's lunchtime here now, and at the moment price is trading as a test for supply. Whether we get that in the end, we'll see. But you can see how price is broken out above this accumulation zone here. This is effectively the accumulation zone here. You can see price gapped out, accelerated higher, tested for supply, accelerated again. There was some consolidation through here. Supply was found to be low, and prices pushed up yesterday and closed at the highest level recently. It's closed above this bar's high, and it's testing for supply today. And if supply is found to be relatively low, or there's determined buying in the market, if supply is drawn out, I would expect price to continue higher in response. Okay, hopefully that helped you understand a little about how a market breaks out above an accumulation zone. That's my lot for now. Let me know in the comments what you thought of the video. Thanks again. See ya.